Welcome to the Deep Dive, the show that takes that endless, often contradictory stream of information swirling around out there, runs it through a high-powered intellectual centrifuge, and delivers the pure, refined gold of insight right to you.
We're here to cut through the noise, to bypass all the conflicting blog posts, the glossy social media pitches, and the millions of articles written by people who often have a very profitable, hidden agenda.
And today, we are tackling one of the biggest, most alluring dreams of the modern digital age, the dream of generating income effortlessly. You know the exact image, don't you?
Oh yeah, the laptop on the beach.
The laptop on the beach. It's the constant backdrop of the internet, the person with their feet in the sand, turquoise water lapping just behind them, supposedly making 5 figures a month while they sip a Mai Tai and send a few emails.
Right.
That intoxicating promise of generating income while you are traveling or sleeping or just relaxing has shifted dramatically. It's no longer just a fantasy. For a huge portion of the population, it now feels like a genuinely tangible, achievable path to financial freedom.
And that feeling of tangibility it's based in reality. We're seeing the financial landscape change so quickly. Data confirms that nearly 1 in 5 U.S. households now report earning some form of passive income.
Wow, 1 in 5.
So it is absolutely a viable, accessible path to building genuine financial flexibility and resilience. But, and this is a big but, the core mission of this deep dive is to understand the chasm between two very different concepts. We have to differentiate what that word passive actually means in the world of asset management and fundamental finance versus what it means in the seductive, highly marketed universe of online schemes.
Okay, let's unpack this because we are constantly bombarded by these pitches. Before we even look at the shortcuts, we need a North Star.
Right.
What is the precise fundamental definition of passive income that we, the sophisticated learner, should be operating with?
This definition is the crucial first step. It's how you separate the genuine asset builders from the digital hustlers. Simply put, passive income is money earned from sources other than a traditional, actively performed job. And critically, it requires little time or ongoing effort after the initial investment of capital, time, or energy has been made. The absolute key here is that the money is generated from a structured asset or a built-in automated system that is designed to function without your daily presence.
So it is definitely not a side hustle. That's active labor like picking up extra freelance clients or driving for a rideshare platform.
Exactly.
We are talking about when you own the asset or the system, and that asset or system is the thing that does the work of generating cash flow.
Precisely. You are investing in assets like shares of stock or bonds, or you're building complex systems like intellectual property or structured rental properties, where the continued generation of revenue is truly decoupled from your day-to-day managerial presence.
And this leads us to the hidden truth, the central principle, the unspoken rule that we are exposing today, because this is the fundamental reality of wealth mastery that the gurus desperately want you to ignore. The rule is this: what looks passive often requires ruthless, hidden labor. Or it's a financial landmine designed to extract capital from the hopeful.
That summarizes our entire objective today. We must differentiate between genuine asset creation, the stable long-term foundations of lasting wealth that demand patience and capital, and the digital shortcuts sold by the modern guru.
Which is what?
Which we categorize as highly leveraged income models that are often high risk and high maintenance disguised as ease.
So we are going to rigorously look at the proven asset-based strategies that have worked for generations. Then we are going to dive deep into the devastating failure rates of modern digital models like dropshipping and course creation. And finally, we will expose the specific psychological manipulation tactics used by those selling the secret formula, including, of course, their reliance on survivorship bias.
Let's start by laying the foundation. Historically, how was long-term wealth built? Before the internet promised you a life of leisure for, $197, passive wealth was built on hard assets that required significant upfront investment. We need to analyze the reliable income streams that demand capital, but in return, deliver predictability and stability.
When we talk about true passive income, we are really talking about the mechanics of putting capital to work so that money systematically generates more money without continuous interference. Let's start with the most traditional, most liquid methods available to the average investor: financial assets.
The top tier is built squarely on reliability and liquidity, the ability to access your funds relatively quickly. First, we look at dividend stocks and funds. The mechanism is, it's pretty straightforward. You own a piece of an established, profitable company, and they regularly distribute a portion of their profits to shareholders.
And this generates a steady income stream, either quarterly or sometimes even monthly.
Exactly.
And the earning potential here is consistent, but it's crucial to note that it's generally not astronomical, right? That consistency is usually the sign of a healthy, stable business model, not some speculative venture.
That's a perfect way to put it. For established, mature companies, the typical annual yield range for dividend payments is generally constrained between 2 and 7%. If you see promises of 15 or 20% consistent yields, you are likely looking at preferred stocks, high-yield debt funds, or high-risk penny stocks, which have vastly different risk profiles. They often involve sacrificing the safety of the principal investment.
So for reliable passive income, the focus is all on the cash flow.
It's all cash flow.
Hmm.
And the fundamental investment strategy here isn't about chasing the next big growth stock or tech unicorn. It's deeply conservative. It's about durability and sector stability.
Right.
Precisely. We see the long-term value in building a portfolio concentrated in recession-resistant, stable sectors. Think utilities, consumer goods companies.
The ones that sell things people need regardless of the economy.
Exactly. Or healthcare.
Hmm.
These industries tend to offer the most reliable payments, even when broader markets are uncertain. However, the true, almost magical power of this strategy lies in compounding returns.
Can you elaborate on that compounding effect? Because this is where the passive nature really starts to accelerate.
It really is. Compounding is where your initial investment starts generating cash, and you then choose to reinvest those dividends to buy even more shares.
Okay.
Those new shares then generate even more dividends, accelerating the cycle. Over a span of 10, 20, or 30 years, this creates an exponential curve. A $1,000 investment today might be generating $40 a year in income, but 20 years later, that original $1,000, now significantly larger due to reinvestment, might be generating $200 or $300 annually.
And it dramatically decouples your passive income from your original effort.
Completely.
And for most listeners, becoming a full-time stock picker is not a viable option. That's where ETFs, or exchange-traded funds specializing in dividends, they step in.
They are a massive advantage because they leverage the expertise of professional fund managers who select and manage those stocks for you. Often, these funds focus on what are known as dividend aristocrats.
I love that term.
It's a specific high-status term for companies that have not just paid dividends, but have consistently grown their dividends for 25 years or more.
25 years.
25 plus years. So when you buy a share of a dividend aristocrat ETF, you are indirectly getting a professionally curated, low-risk selection of stocks with the longest track records of delivering income to shareholders. It's diversification and professional selection rolled into one easily traded asset.
Okay. Now, moving slightly down the risk curve, we have bonds and bond funds. These are the quintessential stable, predictable income stream, often referred to as fixed income.
Bonds are the bedrock of stability. You're lending money to a government or a corporation, and they promise to pay you back the principal on a certain date while paying you a regular fixed interest payment called a coupon in the interim.
So they're generally lower risk than stocks, offering that predictability, but you sacrifice the potential for high growth.
That's the trade-off. The typical annual yield ranges from about 2 to 6% for diversified bond funds.
And when we're analyzing risk in bonds, we need to differentiate between who's issuing it, right? What's the standard risk ladder there?
The latter starts with government bonds, like U.S. Treasuries, which are considered the safest because the issuer has the power to print currency to pay the debt.
So lowest yield, highest safety.
Exactly. Then you move to municipal bonds issued by local governments, which are slightly higher risk but often tax-advantaged. And finally, you have corporate bonds, which offer higher returns, sometimes 5 to 8%, because they carry increased risk, specifically the risk that the corporation might default on its debt.
And the bond funds just smooth all that out.
They smooth out that default risk and provide a diversified approach to a stable income stream across different issuers and maturities.
Okay, let's look at real estate gains without the intense hassle of tenants or property management REITs or real estate investment trusts. This seems to be the ultimate passive play for property.
REITs are invaluable. I mean, they give you liquid exposure to the real estate market without requiring you to deal with direct ownership, the complexities of financing, or the day-to-day management of properties. You are essentially buying shares in a professionally managed portfolio of commercial or residential properties.
I know there's a specific regulatory reason why they're required to be such reliable dividend generators. What is that?
Yes, that is the core structural advantage. Under federal law, REITs are legally required to distribute at least 90% of their taxable income to shareholders in the form of dividends.
At least 90%.
90%. This regulation ensures a high payout ratio, which is why they often have superior dividend yields compared to many other investment vehicles.
And for the sophisticated learner, can we differentiate quickly between the two main types of REITs?
Absolutely. The vast majority of income-focused REITs are equity REITs. They own and operate the properties themselves. Think office towers, apartment complexes, or warehouses. And their income comes directly from rent payments.
So they're generally the safer bet for pure passive income.
Generally, yes. Then you have mortgage REITs or MREITs. Now, these do not own the buildings. Instead, they invest in debt mortgages or mortgage-backed securities, and their income is derived from the interest payments and often financial leverage.
So higher yield, but also higher risk.
Much higher. MREITs typically offer higher, more volatile yields, but carry significantly greater interest rate risk and financial risk, so they're generally considered less stable for the long-term passive investor.
This all boils down to systems that work because you put up the capital and the system is managed by someone else, or the asset is just fundamentally productive. Now we move into real assets and physical systems. And this is where we cross the line into the semi-passive category because the labor requirement starts creeping back in.
It really does.
Let's start with the classic, traditional rental properties. What's the biggest trade-off here?
The trade-off is high potential income versus immense upfront costs and the continuous labor required for management. You are looking at significant capital requirements, 20% down payments, closing costs, and potentially extensive renovations.
And beyond the capital, there are liquidity concerns. You can't just sell a house in an afternoon.
Not at all. You cannot convert a rental house into cash quickly, like you can sell a share of a stock or a REIT. That asset is illiquid until you find a buyer.
And the famous passive illusion breaks the moment you get that phone call about a broken water heater at 2 in the morning.
Precisely. You immediately face the management versus profit trade-off. You can deal with tenant screening, lease enforcement, and maintenance yourself, which is active, high-stress labor that many investors find, frankly, unbearable.
Or you hire a property manager.
Right, which makes the income truly passive, but those management fees can easily eat 8 to 12% of your gross monthly rents. Plus, they often charge lease-up fees of 50 to 100% of the first month's rent for every new tenant.
Ouch. That significantly diminishes your return.
It really does.
When evaluating a property, I know serious investors often use specific metrics to determine if the cash flow is worth the effort. Can you touch on those, like the cap rate or the 1% rule?
Absolutely. These are shortcuts for initial evaluation. The capitalization rate, or cap rate, is the ratio of net operating income to the property's asset value. So if a $200,000 property generates $10,000 in NOI, the cap rate is 5%. Investors use this to compare different opportunities.
And the 1% rule.
The 1% rule is a simpler gut check. The monthly rent should be at least 1% of the property's purchase price. So a $300,000 house should rent for at least $3,000 per month to be considered a strong potential cash flow property. If it doesn't meet those initial thresholds, the labor is likely not worth the profit.
The tax advantages of long-term rental properties are the other major component of why people pursue this. Let's dig into the nuance of how the IRS views that income, specifically the difference between active and material participation.
This is a deep nuance, but it's critical because it deals with how losses can be offset against your active working income. Long-term rental income is initially categorized as passive income. Crucially, this means it avoids the 15.3% self-employment taxes.
Social Security and Medicare.
Right. Although it may be subject to the 3.8% net investment income tax, depending on your income level.
But the truly fascinating part is the ability to deduct passive losses, which often occur due to depreciation write-offs against other income.
Yes. You can deduct up to $25,000 in passive losses against your non-passive income, but only if your participation in managing the property is considered active. This is a lower standard than material participation.
Okay, can you clarify the difference between those two participation levels? Because active sounds like a semantic minefield.
It is a minefield you must navigate carefully. Material participation is required if you want to be classified as a real estate professional, or REP for tax purposes, allowing you to deduct unlimited losses. This requires meeting several high thresholds, including working over 750 hours annually in real estate activities.
Wow.
Active participation, however, is much easier. The threshold is usually met if you put in about 100 hours of work on the property management, such as setting rental terms, screening tenants, or approving repairs. As long as you own at least 10% of the property and actively manage it, you can qualify for that powerful $25,000 deduction.
That deduction phases out at higher income levels, though.
Correct. The deduction begins to phase out if your modified adjusted gross income exceeds $100,000 and phases out entirely at $150,000. It's a powerful incentive for middle-income earners and a clear example of how passive wealth creation often requires strategic hidden labor and detailed tax knowledge.
Okay, let's pivot to some interesting niche tangible assets that are often sold as passive shortcuts, but are definitely firmly in the semi-passive bucket. Vending machines, for example.
Vending machines are a concrete, tangible asset that can produce relatively consistent cash flow. They're often cited as earning between $100 to $500 or more per month per machine,
Wait!
but they are the definition of semi-passive income. They require significant upfront capital for the machine itself, and they absolutely require physical, ongoing labor for restocking, collecting cash, and maintenance.
What determines success in the vending machine game? Because I imagine 90% of machines sit there collecting dust.
Success hinges almost entirely on two factors: securing a location with high predictable traffic, think hospitals, break rooms, or high-volume waiting areas, and optimizing your product mix based on demographic and seasonal needs.
And that location scouting and product optimization, that requires relentless active labor up front.
Absolutely. If you have to drive 2 hours to service a machine that made $50 last month, that business is losing money on labor and gas.
Right. And then we have the burgeoning market for specialty storage and short-term rentals. Not just houses, but assets like RVs and equipment rented out on platforms like Turo or through local services.
This capitalizes on the massive boom in recreational vehicle purchases and the high cost of equipment ownership. Specialty vehicle storage or short-term rentals, whether it's RVs, expensive construction equipment, or even niche items, can be highly profitable.
How profitable?
We've seen reports of high earning potential for high-value equipment rentals, which can toll in $200 to over $1,000 per weekend per item, depending on the niche and local market demand.
But the liability, storage, and labor must be enormous here.
It is significant. You need dedicated, secure storage space for these large, high-value assets. You need physical labor for cleaning, ensuring mechanical readiness, and managing the handover. And most importantly, liability insurance and risk management are paramount. If someone damages your $50,000 RV or injures themselves using your rented equipment, your passive income stream instantly turns into an active legal and financial drain. The income is generated passively once the system is set up, but the maintenance, risk mitigation, and management of the asset are continuous and demanding.
Finally, let's briefly touch on the highest risk asset class for passive capital allocation: startup investing.
This requires the highest possible tolerance for risk and capital loss. The strategy is to invest in early-stage companies, aiming for a successful exit, either an acquisition or an IPO, which can yield dramatic returns, often 10 to 100 times or more on the initial capital.
But the data is grim.
The data is grim. The vast majority of startups fail. The time horizon is extremely long, often 7 to 10 years before any liquidity, and the capital is entirely locked up until that exit. It is zero effort after the investment, but it is the highest risk allocation of capital, suitable only for those who can afford to lose 90% of their investment portfolio.
So if we synthesize part one, the common thread in all genuine, proven passive income strategies is this: it requires significant, often substantial, upfront capital, deep expertise in managing risk, or significant time to build the asset or the system. The money works for you because you already put in the resources.
The barrier to entry for true passive income is high, which is why the stability is high.
Which brings us to the alternative that the internet constantly pitches: the systems that promise you the income without the capital, expertise, or risk. Let's dive into the mirage. This brings us to the digital hustle.
And this is where we must make a crucial distinction between true passive income and leveraged income. Leveraged income is often sold as passive, but it carries a fundamental operational flaw. If you stop actively maintaining and updating it, the revenue stream invariably declines or vanishes entirely.
Okay, define leveraged income for us in the context of a digital product.
Leveraged income is generated through a business model that requires significant, intensive upfront creation like recording, an extensive online course, or writing a comprehensive ebook. The leverage comes from the fact that once created, it can be sold repeatedly, potentially unlimited sales, at virtually no extra cost per unit.
But that leverage only lasts as long as the market deems the product relevant and accurate.
Exactly. It requires ongoing maintenance and support to fight market saturation and obsolescence. If you abandon it, the revenue stream declines rapidly, which fundamentally violates the set it and forget it ethos of true passive income.
The reality of online courses is the prime example here. The scalability sounds passive, but what is the mountain of hidden, continuous labor required to succeed?
The hidden labor is massive, both upfront and ongoing. Upfront, we're talking about intensive time, investment in high-quality video production, professional editing, graphic design, and platform management knowledge.
And beyond the launch.
Beyond the launch, success is entirely dependent on ongoing authority. You must provide ongoing support and engagement Q&A sessions, community forums, constantly updating content to address market changes, to establish and maintain your authority. If you stop maintaining it, market saturation, the constant emergence of new, free, or cheaper competitors, and general obsolescence will rapidly erode your standing and revenue.
This brings us to the ultimate symbol of the promised digital shortcut, the dropshipping paradox. This is marketed as the easiest start due to its low capital requirement and no need for inventory management.
And that ultra-low barrier to entry is precisely why the failure rates are so devastating. The sheer volume of people trying it turns the field into a race to the bottom. We need to state the statistical truth clearly because this number should be a massive red flag for any hopeful entrepreneur.
Okay.
80 to 90% of dropshipping ventures fail within the first 4 months.
Wait, 90%? That sounds almost statistically designed to fail. If the barrier to entry is so low, why aren't any beginners making a sustainable profit?
Because the low capital requirement attracts massive competition and turns the operation into a logistical nightmare for the beginner. Only a tiny fraction between 1 and 5% achieve sustainable profitability, and those are usually highly sophisticated marketers with significant ad budgets. The failure isn't due to the concept, but the execution and the structural operational pain points.
What are the primary structural culprits behind this widespread failure?
They fall into 3 categories. First, supplier reliability and quality control. Beginners often rely on cheap, distant, often international suppliers who offer low reliability and unpredictable quality. One viral TikTok campaign can instantly overwhelm a small supplier, leading to massive shipping delays and product quality issues.
I can see that.
Second, intense margin pressure. Because everyone sources the same products, the competition drives prices down to the point where profits are only realized through massive, highly optimized ad spending. And third, logistics and customer demands.
And customer expectations have risen so high that dropshipping, with its inherent logistical delays and quality uncertainty, simply struggles to compete with established e-commerce giants.
Absolutely. Success in modern e-commerce requires meeting those expectations.
Sure.
We're seeing research estimating that by 2027, 35% of urban buyers will expect same-day delivery for orders under $50.
Same-day delivery, wow.
Dropshipping, with its standard 2 to 3 week international shipping times, simply cannot compete in this environment. Furthermore, customers demand a seamless experience, including easy, friction-free returns. These are all things that reliance on distant third-party logistics partners makes incredibly difficult and expensive to deliver consistently.
This inherent instability leads directly into our next problem. The challenge of platform risk, or what we affectionately call the algorithmic boss. Your leveraged income is almost entirely dependent on the platform's survival, cost structure, and arbitrary rule changes.
A textbook example of this fragility is the relentless process of e-commerce fee erosion, particularly on dominant platforms like Amazon FBA. When you outsource your logistics and sales to a giant platform, their cost structure becomes your immutable cost structure.
And they reserve the right to change those rules constantly to maximize their shareholder value.
Exactly. And these changes aren't minor adjustments. They are systemic shifts that can instantly eliminate low-margin businesses overnight.
Okay, give us a concrete illustration.
Take Amazon's recent changes. For 2026, they announced not just an average fulfillment fee increase, but the introduction of several punitive surcharges. They introduced new surcharges for extra-large products, adding up to $25 extra for certain heavy items. Most critically, they introduced the low inventory level fee, or LIL fee.
Can you explain the practical impact of the LIL fee on a seller's operations?
The LIL fee is calculated at the individual product level based on a seller's inventory versus historical demand over 30 and 90 days. This means if you are a small or medium seller, you can no longer afford to simply stock 100 units to be safe. You must now accurately predict your next 90 days of demand in a highly volatile market or face a punitive tax on your inventory.
So if you're selling high volume, low margin products,
You're in trouble. A fee increase of just a few cents or a new $17 surcharge on a large item combined with the LIL fee can completely obliterate your 10% net profit margin, driving it down to 2 or 3%, forcing you to raise prices or exit the market.
so the incremental nature of these increases is designed to look minor, but is actually designed to maximize Amazon's profit by forcing the seller into relentless, active optimization merely to stand still. You're constantly running just to avoid losing money.
It's the platform, not the customer, that becomes the true boss.
We see the same problem with content creation platforms and the YouTube automation trap. The idea is to create a passive channel by outsourcing all the content scripts, voice, editing, so you just manage the system and collect ad revenue.
It sounds passive, but it's actually a high-investment, high-management business model. The moment you introduce an outsourced team, you introduce significant expenses. You need high investment in a team, professional editors, scriptwriters who understand retention, and managers.
And relying on genuinely cheap solutions.
Like scripts entirely from generic AI tools or stock voices usually leads to low-quality, low-performing content that the algorithm just ignores. The successful automated channels are essentially small media companies with payrolls.
And we have specific data proving that this system, when poorly capitalized or managed, is just a financial hole.
Indeed. A specific study showed a researcher who ran 3 automated channels for 6 months, documenting a total investment of $30,000 for team wage and production costs. The end result:
Let me guess. It wasn't good.
a net loss of $20,100. The reality is that this model is less a passive income stream and more an entrepreneurial venture focused on remote team management, with a high chance of capital drain and a low probability of hitting the massive scale needed to justify the overhead.
And for anyone creating content or running an affiliate business, you are beholden to the algorithmic overlord. This means search engines and social platforms have absolute, non-negotiable control over your income stream, and they change the rules without notice.
This affects affiliate marketing dramatically. Your passive income stream is instantly reduced by technical glitches outside your control. Studies show that affiliate marketers lose between 10 and 14% of potential commission simply due to technical hurdles like tracking issues.
Which are made worse by new privacy regulations and browser updates that block cookies.
Exactly. And the algorithmic bar keeps getting higher, especially for financial health or high-impact content.
Right, Google's Your Money, Your Life, or YMYL.
Right. Google's recent updates show tighter, near-constant scrutiny of content classified as YMYL. To survive and rank, content must meet extremely high EET standards: experience, expertise, authoritativeness, and trustworthiness.
This sounds like the end of the faceless, automated content farm, doesn't it?
It is. If you are running an affiliate site, say, reviewing investment platforms or specific insurance products, you can no longer write generic, recycled content. Google now demands demonstrated hands-on experience. You or your team must show actual testing processes, share real practical experiences, and update content regularly as the platforms and markets change.
So instead of just writing, this trading app is fast, you need to demonstrate it.
You need to demonstrate it. You need to say, after using this mobile app across 50-plus real trades over 3 months, I found the interface loads in under 2 seconds on a 4G connection, and the withdrawal process was executed in 48 hours.
That shift from theoretical expertise to demonstrated experience requires constant active labor and demonstrable authority, the complete antithesis of a passive formula. You have to prove you are a real person who actually used the product.
And what's fascinating here is that the digital products that are scalable, like courses, software, or YouTube channels, only achieve sustained success when you pour massive, relentless active labor into them. The system provides the leverage, but the relentless work of maintenance, updating, and authority building is what makes the revenue flow.
And that leads us directly to the third part of our deep dive. The people who sell the illusion, the gurus, and the psychological mechanisms they use to keep the dream of the shortcut alive, even when the data proves it's a lottery.
The modern guru economy is deeply rooted in human psychology, that desire for a shortcut, the belief that others possess a secret key. While historical movements existed, the internet has given this system unprecedented scale and reach. These individuals sell the idea that success is only a matter of finding the right system, usually found in a downloadable PDF.
Which brings us back to that famous idea of the mechanics of the shovel seller. This is the core business model they operate on, isn't it? They aren't interested in striking gold themselves.
It is the ultimate meta business model. The true, reliable profit is in selling the system, the shovel, not in actually using the system to dig for gold. The money is made by selling the dream of lifestyle, autonomy, and freedom, not by teaching practical, transferable, or enduring skills.
So the audience is the product, not the student.
You see it time and again. Many course sellers have far more success selling their course about dropshipping or Amazon FBA than they ever had actually executing the dropshipping or FBA business model itself.
And they are masters of crafting language to imply proprietary knowledge. We need to identify the marketing magic words that should instantly raise a red flag for listeners.
Be instantly skeptical of vague, metaphorical terms designed to imply a shortcut or secret knowledge that only they possess. If a course prominently uses words like secrets, hacks, formulas, or blueprints, you should question the content immediately.
Why those words specifically?
Because these terms are deliberately non-specific and are intended to generate fear of missing out, or FOMO, and suggest an elite, easy path. I mean, think about it. If the secret knowledge was truly worth millions, they wouldn't sell it to thousands of strangers for $197. The math simply does not support their claim of revolutionary, high-value information.
The internet has also enabled a worrying phenomenon, the redefinition of expertise, significantly lowering the bar for who can call themselves a guru.
This is a key critique. The concept of an expert in the context of selling digital products has been redefined to simply mean someone who knows marginally more about the topic than the purchaser.
So they just need to be one chapter ahead in the book.
Essentially. This enables individuals who have read just a few popular books or watched a few free YouTube videos to repackage and regurgitate that already free information and sell it as unique proprietary knowledge in an expensive high-production course. Their expertise is just a thin layer of research wrapped in great marketing.
And the visual deception plays a huge, often critical role in the sales funnel. That classic picture of the guy standing in front of a fancy car or lounging in a mansion must be highly effective at inducing purchase.
That is success display deception in action. Revenue claims like, "I made $50,000 on launch day," are almost meaningless in isolation. They are designed to hide the net profit margins and the enormous expenses required to generate those sales.
Like the thousands spent on advertising, the commissions paid out to affiliates, or the costs of the product fulfillment.
Exactly. You see the massive revenue dashboard, but you don't see the reality. A slim 8% net profit margin, or the fact that they are standing in a $6 million mansion they don't actually own, was rented for the day of the photo shoot.
The consumer is often naive about the true expenses, taxes, and reality of running these high-volume digital businesses, leading to a massive miscalibration of expectations. But the most insidious psychological tool the guru uses is survivorship bias. This effectively turns success into a lottery model that they sell as a reproducible system.
Survivorship bias is a critical, self-reinforcing psychological flaw. We misjudge the true outcome probabilities by exclusively looking at the successful survivors, the testimonials and highly publicized success stories, while completely ignoring the millions of failures who bought the same course but vanished silently.
We looked at the dropshipping numbers earlier. 80 to 90% failure rate within 4 months. So if a guru sells 500,000 copies of a course on dropshipping and generates 50 verifiable, high-profile success stories to use as testimonials, what does that actually represent statistically?
That is a statistical truth that reveals the system is not reproducible. A success rate of only 0.01%.
0.01.
It is mathematically a lottery, not a reliable, replicable system. But instead of admitting the statistical truth, gurus employ psychological rhetoric that blames the individual for the failure. If you failed, you just didn't work hard enough, or you have to eliminate that limiting mindset and overcome scarcity mentality.
That shifts the responsibility for the flawed system back onto the customer, transforming failure from a predictable statistical outcome into a personal moral feeling.
And that is why it's so important to use a powerful historical analogy to drive this point home. Specifically, the Abraham Wald insight during World War II regarding aircraft armor.
Okay, let's walk through that story fully because it perfectly illustrates the flaw in only studying success.
During the Second World War, the statistical research group in the U.S. military was tasked with minimizing aircraft losses. They began by studying the bullet holes on the planes that returned from missions. They noted that the wings and the fuselage had the most damage, the highest concentration of holes.
Okay, so their initial logical plan was to reinforce those heavily damaged areas, reasoning that they were the most vulnerable.
It seemed logical. But statistician Abraham Wald, who specialized in selection bias, pointed out the critical, counterintuitive flaw.
What was it?
Wald realized they were only examining the planes that had survived the journey. The areas on the returning planes that had fewer bullet holes, such as the engines and the cockpit, were in fact the most critical.
Why?
Because planes hit in those areas were not returning at all. They were lost to the war. Wald recommended reinforcing the seemingly uninjured areas, highlighting the absolute importance of considering the failures, the data that is missing or eliminated, to understand what truly matters for survival.
So when we look at the guru economy, we are essentially looking at the surviving planes. We must, like Wald, study the 90% who failed the course, not the tiny fraction who made it, which is often due to factors unrelated to the course material.
Like superior ad budgets, timing, luck, or pre-existing advantages. The course is just the blueprint. The real success comes from massive unseen factors, and the irony is powerful. The relentless, often unsuccessful chase for passive wealth has a devastating psychological cost, actively fueling the toxic mindset of hustle culture.
The goal is leisure and freedom, but the execution forces chronic overwork and burnout.
Precisely. The chase for passive income often fuels a toxic hustle culture that glorifies continuous, punishing overwork and ties self-worth directly to constant output and productivity metrics. Workers in this culture often sacrifice the ability for critical work-life balance, leading to a rise in anxiety, depression, burnout, and a complete loss of the ability to rest without guilt.
And this chronic overwork actually degrades the very cognitive ability we need to succeed. It's counterproductive.
It is profoundly counterproductive. Our prefrontal cortex, which is the brain region responsible for planning, inhibition, attention, and executive function, needs significant rest to reset. We must value and prioritize cognitive rest, deliberately quieting the mind, stepping away from the screen.
And what happens when we do that?
When you successfully turn off that constant focus mode, you activate the default mode network, or DMN, which is essential for synthesis, boosting creativity, and deep problem solving. This kind of rest is not a sign of weakness or laziness. It is a necessity for maintaining high performance and clear thinking.
So, ditching the continuous grinding isn't laziness, it's a productivity maximization strategy, perhaps by following the evidence-based principles of the 90-20 ultradian cycle.
That cycle is based on innate biological rhythms. Research shows that our periods of high alertness naturally drop off after about 90 minutes. Evidence-based productivity hacks recommend aligning work-rest intervals with this rhythm: 90 minutes of deep, focused work, followed by 20 minutes of intentional rest. This provides a sustainable alternative to the continuous, exhausting grind that hustle culture glorifies.
It's working smarter, not just longer.
Exactly.
Finally, we need to address the newest, most pervasive iteration of this problem, the finfluencers. They operate in a complicated, often highly unregulated gray zone, blurring the line between advice and advertising.
Finfluencers are a new, highly effective intermediary model between financial institutions and retail investors. Their content niche is personal finance, including specific investment recommendations. They're often leveraged by financial institutions to provide general market information, promote specific products, and often make investment suggestions directly to an audience that trusts them implicitly.
And this model raises significant risks related to the lack of licensing and oversight.
Global regulatory bodies like the International Organization of Securities Commissions have flagged numerous acute risks associated with this trend. These include the potential for outright fraud, the promotion of unsuitable or overly risky products the average viewer doesn't understand, the dissemination of misleading content, and most critically, the existence of undisclosed conflicts of interest.
And many of them operate without the necessary licensing or qualifications to provide legitimate financial advice.
That's the core issue.
So if I'm a listener relying on this content for investor ideas, what are the practical, non-negotiable warning signs I should look for to protect myself?
We have 4 clear tips for vigilance. First, verify credentials. Never take financial advice at face value. Always check whether the person providing the investment suggestion is actually licensed or qualified to provide financial advice. Many operate simply as marketers.
Okay, it's second.
Second, be skeptical of guaranteed high returns. Exercise extreme caution with promises of quick profits, guaranteed returns, or systems that claim to beat the market consistently. These are massive indicators of highly speculative, higher risk products or outright fraudulent schemes.
Word.
Demand clear disclosure of compensation and conflicts of interest. Be inherently aware that finfluencers receive compensation for promoting products. If they're pushing a specific trading platform, cryptocurrency, or trying to sell their own course or book, their motivation is compromised. You must demand clear disclosure. And finally, conduct independent, deep research. Never rely solely on social media advice. Always consult registered financial professionals, compare multiple credible sources, and ensure you understand the underlying risk of the product before allocating any capital.
And the compensation models themselves can lead to illegal activity, especially regarding how they are paid for bringing in new customers.
Absolutely. Fixed payments per post or fixed remunerations for affiliate advertising are generally permitted in most jurisdictions, provided disclosures are clear. However, payments made explicitly for bringing in new investors for a brokerage or trading platform often constitute prohibited inducements and may violate securities law, potentially making the finfluencer an unregistered broker.
So the structure of the payment and its direct link to customer signups matters a great deal legally.
It matters a great deal, and the finfluencer may be engaging in high-risk behavior that puts them and potentially their followers in legal jeopardy.
This entire deep dive boils down to one powerful realization. The digital shortcuts and the pursuit of false passivity are often a profound distraction from the fundamental, proven, if less exciting, path to durable wealth. Let's synthesize our findings and look at the alternative. So what does this all mean for you, the learner who is trying to build real financial freedom? Passive income is absolutely real, but the true, stable version requires substantial upfront capital, rigorous risk management, and the consistent, patient building of genuine assets, whether that's a stock portfolio built on compounding dividends or a meticulously managed rental system.
Right.
The digital schemes we analyzed rely on the illusion of ease and the psychology of the shortcut.
And the real systemic risk isn't merely the money you might lose on a bad course. It's the psychological cost of pursuing a false promise, the burnout, the anxiety, and that false sense of personal failure when the lottery ticket doesn't pay out for you, despite the guru's claims.
The ultimate alternative framework for sustainable success is not chasing the latest hack. It's building something that travels with you, something that no algorithm or platform can take away, and no guru can sell you a cheap blueprint for. We call it career capital.
This concept is about viewing your professional life not just as a sequence of jobs, but as a portfolio of compounding portable assets that insulate you against market disruption, including the massive transformation that AI and automation are currently driving. It is the ultimate anti-fragility mechanism.
And we can distill this into 5 pillars of success that form your invisible ladder to enduring relevance.
The pillars are, first, skills and knowledge. This must be continuously updated. The half-life of a technical skill is shrinking dramatically, estimated now at about 2.5 years. Your expertise must be portable and defensible.
Okay.
Second, professional networks. Resilience is often built through relationships. Data suggests that 70 to 85% of opportunities are found in the hidden job market. Your network is your primary defense against sudden job loss.
Third is reputation and credibility,
which is built through demonstrated competence and reliability. In the digital age, this is the ultimate defense against the SEO algorithm's demand for EAT. Your reputation is the only asset that compels attention.
Fourth is character and mindset,
which includes foundational traits like ambiguity tolerance, intellectual humility, and a robust growth mindset that views setbacks as data, not destiny. And fifth, financial resources, which means having a robust runway. This is the capital that allows you to take risks and pursue opportunities.
This framework demands an actionable mindset, prioritizing competence, discipline, and building genuine capability over the intoxicating but fleeting idea of simply following your passion without measurable skill.
Focus on deep work, the ability to perform cognitively demanding tasks in a state of distraction-free concentration. This meta skill fuels the concrete skills needed to stay relevant. We suggest using the 70-20-10 learning rule for resource allocation. 70% of your effort should deepen your core expertise, 20% should build adjacent complementary skills, and 10% should be exploratory, small bets on transformative possibilities that might define the next decade of your work.
And building that financial flexibility is the ultimate hedge against platform risk, algorithmic changes, or global economic shock.
Target a financial runway of 12 or more months of reserves. This level of financial flexibility allows you to say no to bad deals, quit toxic work environments, and take calculated risks during economic transitions without desperation. You're building financial anti-fragility systems and capital that benefit from disruption, rather than being broken by it.
The gurus tell you that if you fail, you didn't work hard enough. They want you to believe that if you just find the right secret, everything will change instantly. But that narrative allows them to profit by selling you the same flawed system again and again, distracting you from the real work.
And that leads us to the final provocative thought. If we accept the reality that timing, luck, systemic structure, and capital allocation matter far more than sheer individual effort alone, the real path to mastery becomes clear. The horrific alternative that they want you to avoid is simply the uncomfortable truth.
Which is,
The secret is that there is no secret. There is only competence, persistence, rigorous asset building, and continuous learning.
they say the unwritten rule of the digital world is don't feed the algorithm unless you're selling something. We disagree. We believe the real unspoken rule is you can't leave without leaving a mark.
If this deep dive clarified your financial vision, validating the hard work of asset building and exposing the mirage of the shortcut, don't just consume. Prove you were here. Like this deep dive to signal that real knowledge and competency are still the highest value currencies.
If you want to ensure you never miss another unspoken rule we uncover, especially those concerning finance and career mastery, subscribe and ring that notification bell. That's how you signal the algorithm that you are in control of your intellectual feed.
And finally, what is the single most ridiculous, unbelievable, get-rich-quick promise or course you ever encountered? Share your story, share your knowledge, and share your skepticism in the comments below. Let's collectively build a collective intelligence against the mirage of the shortcut.